If a company makes $1 billion breaking the law and only has to pay $100 million in fines, did they really get punished? Or did they just pay a fee? Because at the highest levels of business, breaking the law isn't always a mistake. Sometimes it's part of the strategy. What if breaking the law wasn't a failure of a company? What if it wasn't a mistake or a lapse in judgment or even a rogue decision by a bad executive? What if, in some cases, it was simply a calculation? Because when most people think about laws, they think about consequences. You break the rules, you get punished. And that punishment is supposed to be strong enough to stop you and everyone else from doing it again. That idea is simple. It's intuitive. It's how the system is supposed to work. But that logic starts to break down when you scale it up to the level of massive corporations, entities with billions in revenue, teams of lawyers, analysts, and executives whose entire job is to assess risk and maximize returns. At that level, decisions don't happen emotionally, don't happen impulsively. They don't happen in the heat of the moment. They happen on spreadsheets. They happen in boardrooms. They happen through models that weigh upside against downside with precision. So the question shifts. It's no longer why would a corporation break the law? The more uncomfortable question is, why wouldn't they, if the math works? Inside large corporations, there's a language shift that most people never see. You won't find a category labeled crime or breaking the law. Instead, there's something much more neutral, much more clinical. It's called legal and regulatory risk, and that risk is treated the same way as any other business variable. Just like pricing strategy, just like supply chain costs, just like marketing efficiency. Legal risk is quantified, modeled, forecasted. There are teams whose entire job is to answer questions like, what is the probability that this behavior triggers regulatory attention? How long would enforcement take? What is the historical range of penalties in similar situations? What is the worst-case scenario, and how likely is it really? And then, once those answers are estimated, they get translated into something even more important, a number. Because once something has a number attached to it, it can be compared. And once it can be compared, it can be justified. Imagine a company is considering a strategy that sits right on the edge of legality. Maybe it's aggressive pricing. Maybe it's a marketing claim that stretches the truth. Maybe it's cutting a corner in a way that reduces cost but increases risk. From the outside, it might look reckless. But internally, it's not treated that way. It's analyzed. First, they estimate the upside. How much additional revenue could this generate? How much market share could it capture? How much cost could it eliminate? Then, they estimate the downside. What's the likelihood of investigation? If there is an investigation, how long will it take? If there's a penalty, what's the expected size? And here's where it gets critical. Penalties are rarely based on the total benefit the company gained. They're usually based on what regulators can prove, what statutes allow, and what can be negotiated. Which means the downside is often capped, predictable, manageable. So now the company has two numbers: potential gain, expected cost. And if the gain is significantly larger than the cost, the decision is no longer ambiguous. It's rational. At that point, something subtle but important happens. The fine stops being a punishment, and it becomes a price. Not a moral line that cannot be crossed, but a cost that can be absorbed. In many cases, companies don't just accept this possibility. They plan for it. They set aside reserves. They disclose risks in filings. They acknowledge, in carefully worded language, that regulatory actions are possible, even expected. Think about what that means. Not fear of enforcement, expectation of it. And once enforcement is expected, it loses its power as a deterrent. Because deterrence only works when the consequence is uncertain, severe, and disruptive enough to outweigh the benefit. If it's predictable, if it's delayed, if it's manageable, it becomes just another line item. But the structure of the system introduces another advantage: time. Enforcement doesn't happen immediately. Investigations take years. Cases move slowly. Negotiations drag out. Appeals extend timelines even further. And during all of that time, the company isn't frozen. It's operating. It's generating revenue, it's expanding, it's reinforcing the very position that may have been built, in part, on the questionable conduct in the first place. So by the time a fine eventually arrives, something important has already happened. The profit has been realized. The advantage has been secured. And even if the penalty is large in absolute terms, it's often smaller than the total benefit that came before it. There's also a financial reality that makes this even more significant. Money today is worth more than money tomorrow. So if a company earns billions up front and pays a portion of that back years later, the timing alone can make the strategy profitable, even after the penalty. And then there's the question of who actually pays. When a corporation is fined, it creates the appearance of accountability. The number is large. The headline is dramatic. It feels like justice. But look closer. A corporation is not a single person. It's a structure. So when the company pays a fine, the cost doesn't come out of a single individual's pocket. It gets distributed. Shareholders may see a temporary drop in stock price. Employees may feel indirect effects. Customers may eventually bear some of the cost through pricing. But the entity itself continues. The brand remains. Operations go on. And in many cases, the same leadership team stays in place, which creates a strange dynamic. The organization that benefited from the behavior survives, while the cost is spread across people who may not have been directly responsible for the decision. So the idea of punishment becomes diluted. Now consider the perspective of the people making decisions at the top. Executives operate in environments driven by performance, growth targets, revenue goals, competitive pressure. Their incentives are tied to success, bonuses, equity, reputation, advancement, and the risks they face are structured differently. If a strategy works, the upside is immediate and personal. If it fails or crosses a line, the downside is often delayed and corporate, not individual. That asymmetry matters because it shapes behavior. It encourages decisions that prioritize short-term gain, especially when the long-term consequences are uncertain, distant, or absorbed by the organization as a whole. And in large, complex companies, responsibility is rarely concentrated. Decisions are made across layers, reviewed by multiple departments, filtered through legal and compliance teams. By the time something questionable is approved, it often carries a kind of institutional validation, not because it's clearly legal, but because it's been assessed, discussed, and ultimately allowed, which makes accountability harder to assign, and risk easier to justify. There's another effect that doesn't get talked about as much. Every enforcement action sends a signal, not just to the public, but to other companies. It shows what behavior triggered attention. It shows how regulators responded. And most importantly, it shows what it cost. That information doesn't disappear. It gets studied, analyzed, incorporated into future decision-making. So when one company pushes a boundary and pays a fine, competitors aren't just observing the violation. They're learning the price, and that changes the landscape. Because if the cost of crossing the line is lower than the cost of staying behind it, the incentive flips. Companies that remain conservative may actually be at a disadvantage, while those that take calculated risks can gain ground. Over time, that pressure builds. More companies adopt similar strategies. The behavior spreads, and what was once considered clearly unacceptable starts to feel normal. This creates a feedback loop. A company tests a boundary. It benefits. Enforcement comes later. The penalty is absorbed. Competitors adjust. The baseline shifts. And the system evolves. Not through a single dramatic failure, but through a series of small, rational decisions. Each one justified. Each one calculated. Each one pushing the line just a little further. Until eventually, the distinction between legal and illegal behavior becomes harder to see. Not because the rules disappeared, but because the incentives surrounding them changed. At this point, it's worth asking a harder question. If fines can be anticipated, priced in, delayed, and absorbed, what role are they really playing? Are they stopping behavior, or are they regulating it? Because there's a difference. Stopping behavior means creating a barrier that cannot be crossed without severe consequences. Regulating behavior means allowing it, but attaching a cost. And when that cost is predictable, it becomes part of the system. Something that can be managed, optimized, even leveraged. So when you see a headline about a massive fine, it's worth looking beyond the number. Because the number alone doesn't tell you whether the system worked. It doesn't tell you whether behavior changed. It doesn't tell you whether the underlying incentives were disrupted. Sometimes it simply tells you the price that was paid. And once something has a price, it stops being a boundary. It becomes a decision. And that may be the most uncomfortable realization of all. That the system isn't necessarily failing. It may be operating exactly as it was designed. Balancing enforcement with economic activity. Allowing risk, but containing it. Not eliminating questionable behavior, but managing it within certain limits. Which means the question isn't just why corporations don't fear breaking the law. The deeper question is, what happens when the law becomes just another variable in the equation? Because in that world, the line isn't drawn in black and white. It's drawn in numbers. And numbers can always be worked around.